Most homeowners think a HELOC is just another second mortgage that traps you in more debt and a scary payment jump after a few years. What if I told you there's a completely different kind of HELOC? One that puts you in first position, gives you 30 years of access, and actually lets most people wipe out their entire mortgage in 3 to 7 years instead of adding to the problem. Here are 3 major differences between a first lien HELOC and a traditional home equity line of credit. First off, a traditional HELOC is almost always in second position behind your existing mortgage. Most of you bought your home with a regular 30-year fixed mortgage. Over time, you built up equity in the house. When you go to a lender and say you want to tap into that equity, they usually give you a second mortgage. That's the typical home equity line of credit. What I teach is completely different. A first position HELOC. You can use it to buy your next home outright, or if you already own a house, you can refinance and pay off your current mortgage. Once that happens, the HELOC steps into first position and literally becomes your new mortgage going forward. That's why we call it a first lien HELOC. The second big difference is the draw period. With a traditional HELOC, the bank usually gives you anywhere between 3 to 10 years to draw on that line. During that draw period, you can pay it down, run it back up, use it however you want. You only have to make interest-only payments on whatever balance you have. But here's the catch. Once that draw period ends, you lose access to the money completely. And now you have to start paying back the balance in full. Principal plus interest usually amortize over 20 years. If you still owe 100K or 200K when that clock runs out, get ready for a very rude awakening. Your payment is about to jump hard. With our first lien HELOC, you get a 30-year draw period, 30 full years of access to your line of credit. No rush, no panic about the window closing. You have plenty of time to invest, use the money, or pay it down on your own schedule. And the third major difference, and this one's huge, is what it actually does to your debt. A traditional second position HELOC is just adding more debt on top of your existing mortgage. Most people don't pay it off during that short draw period. So when the draw period ends and the payment skyrockets, the lender might come back and say, hey, want to refinance your first and second together into a new 30-year loan? A lot of people do it because it lowers the monthly payment. And then they're right back to where they started. Another 30-year mortgage, especially if they've also loaded up credit cards on top of it. It becomes a painful cycle. With the strategy that I teach, the 30-year first lien HELOC, we're actually talking about debt elimination, not more debt. Most of our clients pay off their entire mortgage in 3 to 7 years. That's it. Game over. So when you hear HELOC, don't automatically picture a second mortgage tacked onto your existing loan. There are first position HELOCs available. And that's exactly what I specialize in teaching. This is Joel, the Mortgage Guide. Feel free to ask me any questions regarding this process. Take care of yourself and each other.
If you'd want more content like this, hit like, subscribe.